यार माई सेल्फ सी काजल जिंदल प्रैक्टिसिंग चार्टर्ड अकाउंटेंट इन मानसा पंजाब। हमारा आज का वेबिनार का टॉपिक है डिस्कशन ऑन फॉर्मेट्स फॉर फाइनेंशियल स्टेटमेंट्स ऑफ नॉन कॉर्पोरेट एंटिटीज। इसके लिए सबसे पहले मैं थैंक यू करूंगी सीए हितेश गोयल जी का, जिन्होंने हमारा आज का वेबिनार ऑर्गेनाइज किया। हमारे आज के स्पीकर रहेंगे सीए राजेश कुमार जैन, जो कि प्रैक्टिसिंग चार्टर्ड अकाउंटेंट हैं सिंस 1989 और सीनियर पार्टनर हैं जैन एंड अनिल सूद फर्म में इन लुधियाना। एकेडमिक्स भी इनके काफी अच्छे रहे हैं। सीए फाइनल में इनका 40th रैंक रहा है और इंटरमीडिएट में भी ऑल्सो 15th रैंक रहा है ऑल ओवर इंडिया। बीकॉम ऑनर्स में भी इन्होंने सेकंड सेकंड पोजीशन आई थी इनकी पीयू चंडीगढ़ में। थैंक्स टू सी हितेश राजेश सर, हैंड ओवर टू यू।
Thank you, Ma'am Kajal ji.
वेलकम सर।
I express my thanks to CA Hitesh Goyal ji, who is working very hard and for updating the knowledge of the members of this part. This is YouTube channel Knowledge Refresher and Updation series. He continues to hold so many webinars for the benefit of the members, and he has given me this opportunity to discuss my views on this format of our financial statements of non-corporate entities. May I request the host to give me share the file? Can I share it?
Sir, you are already co-host, so you can.
Thank you. Thank you, Hitesh ji.
Is she wanting to check in? Now she was checking. She wants to check in now. That's right.
Is my screen visible to all the participants?
Yes, sir.
यस सर।
Okay, I will.
So the institute has issued a guidance note on the formats for the financial statements of non-corporate entities.
All right.
Basically,
We have
for corporate entities, we already had a format prescribed by the Ministry of Corporate Affairs. The non-corporate entities were already preparing financial statements in different formats. Some were using T-shape, some were using horizontal or vertical. Basically, the institute felt the need that to increase the trust of the stakeholders, like the lenders, tax authorities, that the financial reporting of an entity should be comparable, transparent, complete, and unbiased. Keeping this in mind, the Institute of Chartered Accountants of India, through Accounting Standard Board, has issued a guidance note on financial statements of non-corporate entities. The basic purpose was to standardize the formats of these non-corporate entities and to enhance the quality, comparability, and comprehensiveness of the financial reporting by non-corporate entities. Because earlier, for companies, we were already having Schedule 3 format prescribed by the Ministry of Corporate Affairs. Now, for the first time, the Institute has issued us a guidance note on the financial statements of non-corporate entities. Basically, the process started during 2022 with the issue of technical guide on the financial statements of non-corporate entities. This was recommendatory for 2 years, that is for financial year 22-23, 23-24. But from
Yeah, he's coming.
don't know how to check in.
with effect
So you
from
just call Nishit, na? Nishit will come down.
ma'am,
Okay, I've
somebody,
sent. Jayashree number is there?
Might have a
Who one is speaking, प्लीज अनम्यूट योर म्यूट कर लीजिए प्लीज अपनी तरफ से। आवाज आ रही है किसी की।
basically this process of financial statements of non-corporate entities, standardization of non-corporate entities started in June 2022 with the issue of technical guide. This was recommendatory for first 2 years, that is for financial year 22-23 and 23-24. During August 2023, this technical guide has been superseded by the guidance note on financial statements of non-corporate entities, which is mandatory to be complied with effect for financial statements commencing on or after 1st April 2024, which means that for current financial year 24-25, this guidance note on financial statements of non-corporate entities is mandatory in nature. This includes all types of non-corporate entities, but it excludes LLPs, limited liability partnerships incorporated under the LLP Act 2008, non-corporate entities where the law governing those non-corporate entities, regulation or the authority has prescribed any other specific format which does not match with the format for non-financial corporate entities prescribed by the Institute of Chartered Accountants of India. Suppose in case of trust of any state or society, they have prescribed a specific format for the preparation of financial statements of that corporate or trust. In that case, this guidance note shall not apply, but the guidance or the format prescribed by the relevant authority shall be applicable. For LLPs, because it is being governed by Ministry of Corporate Affairs now, the separate format prescribed by LLPs shall be applicable. Now, what is the scope of this guidance note? Non-corporate entities, as per this guidance note, includes following type of non-corporate entities: sole proprietorship firms, or you call it proprietorship firm; Hindu undivided families carrying on business or profession; partnership firms, including unregistered firms, because registered firms or unregistered firms both are considered as partnership firms for the purpose of preparation of financial statement. Any kind of association of persons or the body of individuals, registered welfare association of any society, trust, statutory corporation, autonomous body, local authorities, any other form of organization which is engaged fully or partially in any kind of business or professional activities. You see, all corporate entities and all LLPs are not covered by this guidance note. This guidance note covers only these 5-6 categories of formation of entities which are considered as non-corporate entities. If a specific format has been prescribed by any relevant statute governing that non-corporate entity, or any regulator has prescribed a specified format, then this format issued by the Institute of Chartered Accountants of India through this guidance note shall not apply. Only the format issued by that relevant statute or the regulator or the authority shall apply. Now coming to what is the complete set of financial statements as per this guidance note. The complete set of financial statement normally includes the balance sheet, the statement of profit and loss, and the cash flow statement wherever applicable. Because from this year onward, for financial year 24-25 onwards, the institute has also revised the category, the classification of entities which were earlier level 1, level 2, level 3 and level 4. Now the institute has come up with 2 categories only: micro, small and medium enterprises and large entities. The level 2, level 3 and level 4 entities all have been clubbed into level MSME, and level 1 has been converted into large entity. But you see, cash flow statement is only applicable to large entities. Micro, small and medium entities, which are micro, small and medium enterprise, as per turnover and borrowing criteria prescribed, new criteria prescribed by the institute, that entities are not required to file cash flow statement. But for large entities whose turnover during the immediately preceding financial year was 250 crore or more, or the borrowing was 50 crore or more, they are large entities. They are also required to, large non-corporate entities, they are required to prepare the cash flow statement. Means for large entities, there are three part of a financial statement apart from notes and other explanatory material. That is balance sheet, statement of profit and loss, and the cash flow statement. And notes to accounts and other explanatory material like significant accounting policies or other notes relating to the financial statement. But for medium and small entities, it will be balance sheet, statement of profit and loss, notes and other statements and explanatory statement plus including significant accounting policies. But cash flow statement will be applicable only to large entities whose turnover during the immediately preceding financial year was 250 crore or more, or the borrowing was more than 50 crore rupees. What are the key changes brought on by this guidance note on financial statement of non-corporate entities? Disclosure of comparative financial statements for the immediately preceding reporting period. Now, in case of an other than new entity, if it is an entity which existed during the immediately preceding financial year also, disclosure of comparative financial statements are mandatory. If it is the first financial year and if it is a new entity and this is the first financial year, then disclosure of comparative financial figures are not applicable because this has been incorporated during the current financial year only. Then T format, which we earlier used, right side income and left side expenditure, that is no longer allowed. Only the vertical presentation as provided in this guidance note is acceptable. Earlier we used to have T-shape format, horizontal format or vertical format, but now only the vertical format which is provided in the guidance note is unacceptable. The T format, left side expenditure and the right side income is no longer allowed. The main changes with this guidance note is classification of all assets and liabilities as current or non-current. Because you see earlier, we never classify liabilities into non-current and current or the assets into current or non-current for non-corporate entities. We used to do it for corporate entities because term loans are long-term liabilities. We extract current maturities out of those long-term loans that are shown under current borrowing. All other amounts are shown as long-term borrowings. But in non-corporate, we used to show only the loan funds, including the current and the non-current. But now, with this guidance note, we have to classify all the assets and liabilities as current or non-current. Current maturities of all long-term borrowings must be separately disclosed under current borrowings. You see, earlier we show borrowings under the head liabilities in the financial statements of non-corporate entities. But now these liabilities are to bifurcated into current borrowing and non-current borrowing, or other liabilities which can be classified as current or non-current. They are to be disclosed separately. Similarly, for assets, all these assets are to be separately disclosed as current and non-current. Like securities, electricity security is never a current asset. Earlier we have a one schedule, loans and advances, current assets, loans and advances. All those current assets, loans and advances includes non-current and current assets. But now all those assets which are current in nature, means which the realization of which can be possible in next 12 months, these are to be shown as current assets. All those assets which are not realizable within next 12 months, these are to be shown as non-current assets. Electricity security, telephone securities, these are all non-current assets So these are to be shown separately under the head non-current assets. Disclosures related to nature of security, guarantees, and other terms of borrowings for all borrowings has to be disclosed. Earlier, we never used to disclose these kind of nature of securities, guarantees, and other terms of the borrowings for non-corporate entities. But now we have to look into the sanction letter of the financial institution or bank or NBFC. From there, we have to derive what is the nature of security, who has granted those borrowings, and what are other terms of borrowings of all borrowings from banks, financial institutions, and NBFCs. Then separate disclosure of trade receivable outstanding for a period exceeding 6 months from the date they are due for receipt. As in case of companies, we give aging schedule also. But in non-corporate entities, aging schedule is not required. But at least bifurcation of trade receivables for outstanding for a period exceeding 6 months from the date they are due for receipt. This is not from the invoice date. This is invoice date plus credit period plus 6 months. Suppose you have issued an invoice on 1st of September with a credit period of 30 days, means due date 1st of October. That means for 31st March, it will be considered a trade receivable outstanding for a period not exceeding 6 months. If any amount is due on or before 30th September, it will be considered as outstanding for a period exceeding 6 months. Any amount due from not from the date of invoice, due date after giving a credit period. If the outstanding date is 1st October onwards, that means it is not exceeding 6 months. This is to be shown separately, and trade receivable exceeding 6 months from the due date are to be shown separately. Apart from this, in companies we do aging schedule also for up due for 6 months, then 1 year to 2 years, 2 years to 3 years. But in case of non-corporate entities, this kind of separation of aging schedule of trade receivable is not required. Only the trade receivable exceeding 6 months from the date they are due for receipt are to be disclosed separately within the total trade receivable. Means two classification: trade receivable more than 6 months old, trade receivable less than 6 months old, the total trade receivable. Now this is the format of the balance sheet as per the guidance note. It starts with equity and liabilities, owners funds, owners capital, reserves and surplus. Then the liabilities are classified into non-current liabilities and current liabilities. There are three categories of liabilities and equity side. That is why it has been nomenclated as equity and liabilities. Equity means owners funds, owners capital account means current account, the reserve and surplus. In some case, there can be a capital reserve in non-corporate entities also. That is why this a separate line item has been kept for reserve and surplus. Then all the liabilities existing on the balance sheet date are to be classified into non-current liabilities and current liabilities. Non-current liabilities has four limbs again: long-term borrowings, deferred tax liabilities, net of deferred tax asset, other long-term liabilities, and long-term provisions. In case of gratuity, there can be any amount of gratuity which is due within next 12 months is to be shown as short-term provision. Gratuity exceeding 12 months is to be shown as long-term provision. Then current liabilities, again borrowings, short-term borrowings. Short-term borrowings will also include current maturities of long-term borrowings. Long-term borrowings, any amount due within next 12 months from the date of the financial statement is a short-term borrowing. Then trade payable, these are to be separated into micro, small and medium enterprises and micro, small and other than micro, small and medium enterprise as per MSME Act. Then other current liabilities, short-term provision. This will be the total of the liability side, liability and equity
Other
side.
current assets unde Nihal.
Hello? Any issues? In the asset side, there are two categories, non-current assets and current assets. Within non-current assets, first of all, property, plant and equipment and intangible assets divided into separately for property, plant and equipment and intangible assets. Then capital work in progress, any intangible assets under development, non-current investments, deferred tax asset, net of deferred tax liabilities. Deferred tax assets and liabilities are not to be shown separately, that you show deferred tax liabilities on the liability side, non-current liability, or deferred tax asset on the asset side as non-current asset. It is to be netted. Deferred tax assets and deferred tax liabilities are to should be shown net. If it is liability, deferred tax liability exceeds deferred tax asset, then deferred tax liability is to be shown as non-current liability. But if the deferred tax asset exceed deferred tax liabilities, then deferred tax assets net of the deferred tax liability is to be shown as non-current asset. Then long-term loans and advances, other non-current assets. There can be category of other non-current. Security is one type of other non-current asset. Security which is not realizable within next 12 months from the date of the balance sheet is a other non-current asset. Long-term loans and advances, any loans which are not due for repayment within next 12 months shall be classified as long-term loans and advances. Then under current assets, current investments, any investments which are held for trading purposes or any investment within next 12 months, these are current investments. Then inventories, trade receivables, cash and bank balances, short-term loans and advances, and then the residual class, other current assets. This will be the total of all the assets and liabilities. If we look into the format of this financial statement, every line item is to be linked with a note number. That is why it is C accompanying notes which form part of the financial statements. We have to also include accounting policies under these notes. This all note number should be relinked. It should be linked with the financial statements. Suppose note number 1 is capital, owner's capital. The owner's capital note number should carry note number 1 and the total amount should be carried to the owner's funds count. Now, as per this format, there are general instructions in the guidance note how to prepare or what considerations to be given for the preparation of the balance sheet of a non-corporate entity. The basic purpose is, first of all, the financial statement should give a true and fair view. It should comply with the applicable accounting standards. We'll look into the accounting standard part later on because the accounting standards are directly linked with the preparation of the financial statements of a non-corporate entities. Because for non-corporate entities, only the accounting standard issued by the Institute of Chartered Accountants of India are applicable. For corporate entities, we have a separate set of accounting standard issued by the Ministry of Corporate Affairs. For all types of non-corporate entities, accounting standard issued by the Institute of Chartered Accountants of India are applicable. So the financial statement should give a true and fair view. It should comply with the applicable accounting standards and be in the prescribed form. Prescribed format has already been prescribed through this guidance note. That means financial statement should have 3 limbs. It should give a true and fair view, comply with the relevant applicable accounting standard, and be in the prescribed form. Of course, one could modify this format as required by any statute or any accounting standard. If any accounting standard or any relevant statute governing that non-corporate entity require that this item should be disclosed separately, then you can modify the format to that extent. Suppose accounting standard require disclosure of related party transactions. Related party transactions are not to be shown on the face of the balance sheet or the profit and loss account. You have to include a separate note number for the related party transactions. Similarly, the description used in this financial statement can be amended if, suppose in case of association of persons, the terminology used owners fund is not appropriate, then you can use members funds, or the partners funds can be used in case of partnership firm. There is not a hard and fast rule that you have to use this terminology only. It can be amended according to the requirement of a particular entity, according to the requirement given in the relevant statute governing the non-corporate entity, or a line item which can be amended according to the applicable standards, accounting standards to that relevant entity. There are another general instructions which includes additional disclosures specified in the accounting standard. In all other disclosures required by the relevant statute shall be made in the notes to accounts in addition to the requirements set out in these formats. The format specified includes only the balance sheet and the profit and loss account. Suppose in case of large entity, cash flow statement is applicable. Then that cash flow statement is to be prepared as per accounting standard 3. Or any disclosure required by AS 15 employee benefits. Post-retirement benefits disclosures are required by AS 15 employee benefits. Then you have to additionally disclose. You cannot say that the format does not include the related party transactions or the employee benefits transactions, because any additional disclosure required by applicable accounting standards or any disclosure required by relevant statute. Suppose a specific trust or society act requires that these statements these particulars should be disclosed in the financial statements of that trust or the society. Then additional disclosures are must. That will be in addition to the format prescribed by this guidance note. Then the notes of accounts which shall contain information addition to that presented in the financial statement and provide wherever required narrative description or disaggregation of items recognized in those financial statements. Disaggregation means, suppose there are inventory. In case of inventory, you have to disaggregate inventory into raw material, finished goods, work in progress, loose tools, store and spares, traded goods. This disaggregation shall be done through a notes to the financial statement. That is, separate note will be prepared for the inventory containing raw material, finished goods, work in progress, and the total shall be linked to and carried over to the financial statement, that is balance sheet. Information about items that do not qualify for recognition in financial statement, like contingent liabilities. Contingent liabilities are not included in the financial statement. They are not part of the total of the assets and liabilities of the financial statement, but information that about that item should also be given proper space in the financial statement, like contingent liabilities, claim against the companies not acknowledged debts, or the bank guarantees, which I talked about. Each item on the face of the balance sheet and statement of profit and loss shall be cross-referenced to any related information in the notes to accounts. Means balance sheet note number should tally with the description and disaggregation of item in the note number. earlier we are compulsorily required to round off the figures of our corporate entities. With this guidance note, we have been given an option. It's not mandatory. It is not mandatory that we should round off the figures of a non-corporate entity, but an option has been given that if the total income of the non-corporate entity, the figures in the financial statement may be rounded off. It's not compulsory, but they have given an option. If the total income is less than 100 crore rupees, the figures can be rounded off to the nearest hundreds, thousand, lakhs, or millions, or the decimals thereof. But if the turnover 100 crore or more, then to the nearest lakhs, millions, or crores, or decimal thereof. But usually we prepare financial statement of non-corporate entity in rupees, but an option has been given that if you want to round off, then you can round off. But if the turnover of that non-corporate entity is more, the total income of the non-corporate entity is more than 100 crore rupees, then you cannot round off it to nearest hundreds, thousands. It has to be to nearest lakhs, millions, or crores, or the decimals thereof. And if you use the round off formula in the balance sheet, then once a unit of measurement is used, suppose you are preparing the balance sheet or the full set of financial statements in lakhs, then it should be used for in uniformly in the set of financial statement. Then you cannot use thousands somewhere, hundreds somewhere, millions somewhere, or crores somewhere. You have to use lakhs throughout the financial statements. Then what I talked about comparatives also, except in the case of first financial statements prepared by the non-corporate entity, the corresponding amount, that is comparative amount, should for the immediately preceding reporting period for all items appearing in the financial statement should be included in the notes, profit and loss, and the face. Means we have to revise all those figures appearing in the 2024 balance sheet if that balance sheet has not been prepared according to this format. We have to reschedule all the liabilities into current versus non-current. Similarly, assets into current versus non-current. We have to give aging schedule of the trade receivable. We have to give all the terms and condition of the loans availed. And we have to classify liabilities into secured, unsecured, similarly trade receivable and loans and advances into secured, unsecured. Lot of exercise is to be done for the last year's balance sheet also if that balance sheet has not been prepared according to this format. Coming to what is there in the headwise balance sheet. Owners funds. First of all, on the liability and equity side is the owners funds. Owners funds means the partners funds or the proprietors funds or the trust funds. This should be classified into these 7 categories: opening balance of the owners funds, capital introduced oblique contributed during the year, remuneration for this year, interest for the year, withdrawals during the year, share of profit or loss for the year, share in percentage and amount. Percentage is to be shown and amount of the profit is also to be shown. Then the closing balance. This figure is to be shown in a separate note. Then the resultant figure in the note is to be carried to the face of the balance sheet. And the reserve and surplus. Then second line item in the balance sheet is the reserve and surplus. If there is a debit balance in the reserve and surplus, even then the negative figure should be carried over to the reserve and surplus schedule under the equity and liability side. Not only the credit balance is to be shown, even if it is a separate negative figure, this negative figure, instead of showing it on the asset side, it is to be shown as reduction from the equity and liability side, not as asset side or below the line in the asset. You should use third line item as a non-current asset, current assets, or the debit balance of reserve and surplus. This is not permitted. The balance of reserve and surplus, if it is a negative, it is to be shown as reduction from the owners funds on the liability and equity side. Now this needs a lot of exercise to be done. All the long-term and short-term borrowings shall be presented separately as non-current borrowings and current borrowings. Then further, all the borrowings shall be classified as secured borrowings and unsecured borrowings. Then for all secured borrowings, nature of security shall be specified separately in each case. This nature of security is to be taken from the sanction letter of the bank or the financial institution or the NBFC. Whatever be the nature of security, that is to be mentioned under the head secured borrowings, where loans have been granted by partners, proprietors, owners, or others. The aggregate amount of such loans under each head shall be disclosed. Apart from nature of security, if a loan has been granted by third party or by the owners, the aggregate amount of such loans under each head shall be disclosed separately. Means all securities which have been offered to the financial institution and all guarantees which has been given to that financial institution shall be disclosed along with the borrowing amount. Then for all kind of loans, whether family loans, related party loans, or term loans, all the terms of repayment, means what is the repayment schedule, what is the rate of interest, these terms of repayment of all the term loans, long-term borrowings or short-term borrowing shall be stated. Current maturities of long-term borrowing, which we have already discussed, that all long-term borrowings, any amount due within next 12 months from the long-term borrowings shall be disclosed separately under the head short-term borrowing. It is not to be disclosed under other current liabilities. The amount due within next 12 months is to be shown under current maturities of long-term borrowing under the head short-term borrowings. Then after borrowings, it comes trade payable. Trade payable, all the details required under section 22 of the MSMED Act shall be disclosed in by way of notes. Because this year 43BH performance has also been changed through 3CD form. Now this 22 section MSMED requirements are different from 43BH. We have to disclose separately as by way of note. Then other current liabilities. Any interest accrued but not due. Any interest accrued but not due on all borrowings and interest accrued and due on borrowing shall be classified under other current liabilities and not borrowings. If any interest has accrued but which is not due, it should not be included in borrowings. It should be shown as under other current liabilities. Then coming on the asset side, first head is property, plant and equipment. We require this reconciliation of the gross carrying amount and net carrying amount. Means we have to show gross carrying amount, opening block, additions during the year, sales or sales during the year, and the closing balance of gross carrying amount. Then depreciation block, opening depreciation, depreciation provided during the year, depreciation written back, and closing depreciation block. Then net block. The assets under lease shall be separately disclosed under each class of asset. The property, plant and equipment is to be classified into land, building, plant and equipment, furniture and fixture, vehicles, office equipment and other assets. The assets under lease has to be disclosed separately. Then if any assets have been revalued, if the revaluation more than 10% or more, then the net carrying value of each property, plant and equipment shall be adjusted and related depreciation and impairment losses reversal shall be disclosed separately. In case of intangible assets, same type of intangible asset shall be classified in a different heads. Then reconciliation of gross and net carrying amount of each class of asset shall be reported in the same format: opening, additions, deletions, and closing balance. Then in case of depreciation or intangible assets shall be disclosed net of whatever we have written off. Amortization, it is to be opening amortization of that intangible asset, intangible assets amortized during the year, and the closing amortization amount, and the resultant figure will be the net amount of intangible asset. Generally, we do not carry non-current or current investments in a non-corporate entity, but if it is there that the non-corporate entity is also carrying investments which are to be then current asset, these investments are to be classified into non-current investments and current investment. Non-current investment then should be classified as trade investment and other investment. Generally, in case of non-corporate entity, we do not carry trade investment. If at all their investments are there, these are not a trade investment. Then non-current investments carried at other than cost should be separately stated, specifying the basis for valuation thereof. If a non-current investments are generally to be valued at cost, if for some other reason or there is impairment of the non-current investment, if it is not carried at cost, then it should be separately disclosed, specifying the basis for the valuation of that non-current investment. Basis for valuation shall be disclosed for all kind of individual current investment. Then below the total of the non-current investment, the following amounts has to be disclosed: the aggregate amount of all quoted investments and the market value thereof, the aggregate amount of unquoted investments, the aggregate provision for diminution in valuation of investments. Then coming to loans and advances. First of all, these loans and advances are to be classified as long-term loans and advances and the short-term loans and advances. Capital advances are always long-term advances. You see, capital advances are to be converted into fixed long-term property, plant and equipment. That is why all the capital advances shall be classified under the head long-term loans and advances, not under short-term loans and advances. Because we advance a capital advance for the purchase of property, plant and equipment. As and when the property, plant and equipment shall be purchased, this advance shall be converted into non-current asset. So the capital advances has to be classified under the head long-term loans and advances and not under the head short-term loans and advances. Any long-term loans and advances or short-term advances to related parties, these are to be disclosed separately, giving the details thereof. As we already discussed, the loans and advances shall be separately subclassified as secured and considered good, unsecured considered good, doubtful. There are three categories of loans and advances. If it is secured, then secured and considered good. If it is unsecured, then unsecured considered good. If there is any doubtful loans and advance, it allows for that bad and doubtful loans and advances has to be made, and a separate amount of doubtful loan and advance is to be shown. First of all all the loans and advances are to be classified into long-term loans and advances and short-term loan and advances. Then after that long-term, short-term classification, the loans and advances shall be separately classified as secured, unsecured, and doubtful. Then other non-current assets. This is a residual clause for non-current assets, security deposits, and bank deposits with more than 12 months maturity shall be classified under other non-current asset. This is an example that security deposit and fixed deposit with more than 12 months maturity. There can be other non-current assets. This is a residual clause. Any amount which cannot be classified under loans and advances, that is to be classified as under other non-current asset. Security deposit is never a long-term loan or short-term loan. It is another non-current asset. Any fixed deposit which is not due within next 12 months from the date of the financial statement, it means it is a non-current asset. It is to be shown under other non-current assets, not under the current assets. Then coming to the current asset side, we have already discussed about first limb, current investment, that we have already discussed how to show current investments. The second limb in the current investments is inventories. Inventories shall be classified under the raw materials, work in progress, finished goods, stock in trade, store and space, loose tools, and others. The total inventory has to be classified into these subheads to the extent possible. Stock in trade is to be shown separately only in case of if the goods have been acquired for the purposes of trading. Within all these heads, if there are goods in transit, means if raw material you have purchased and the risk and reward has been transferred to your account and the raw material has not been received at your premises, that means it is goods in transit. It should be separately disclosed under the relevant head of inventories. Trade receivable. This part we have already taken care of, that the aggregate amount of trade receivable outstanding for a period exceeding 6 months from the date they are due for receipt shall be stated separately. Then again, trade receivable has to be classified as secured, considered good, unsecured, considered good, the doubtful. If there are doubtful trade receivable, the allowance for bad and doubtful trade receivable shall be disclosed separately. Cash and bank balances. Here, cash and cash equivalents and other bank balances are to be disclosed separately. Cash and cash equivalent means bank balances or deposits maturing within next 3 months. All those deposits having a maturity period of 3 months or more but less than 12 months, these are to be disclosed separately under other bank balances. These are not to be included in cash and cash equivalents, because cash and cash equivalents are relevant for those entities which prepare cash flow statement. Any fixed deposit which mature have a maturity period of more than 3 months but less than 12 months, these deposits are not to be included in cash and cash equivalents. These deposits are to be included in other bank balances. Any deposit maturing more than 12 months from the date of reporting date, it is to be taken as other non-current asset. Deposit maturing within 3 months are to be taken into cash and cash equivalent, and the deposits maturing in between 3 to 12 months are to be taken into other bank balances. Sometimes we have given deposits for as a margin money for bank guarantee or the letter of credit. These are to be disclosed separately. If these deposits are maturity of 12 months or more, then these are to be classified as under other non-current assets. Otherwise, under this cash and bank balances, cash and cash equivalent or other bank balances. Other current assets. Again, this is for within the current asset. This is and all inclusive heading which incorporate current assets that do not fit into any other asset category like trade receivable, loans and advances. If this and there is any item of current asset which does not fit into loans and advances or cash and cash equivalent, cash, other bank balances, that item has to be classified under other current assets. Then off balance sheet items which are not to be taken into the total of the assets and liabilities. There are the contingent liabilities which has not been provided for. Contingent liabilities include claims against the non-corporate entities which has not been acknowledged as debt by that non-corporate entities. Guarantees or counter guarantees given to banks for any kind of guarantees given to regulator or guarantee given to where we are third party guarantor, means we have given counter guarantee to the bank and bank has issued a guarantee on our behalf to the person who requires a guarantee from us. All those guarantees are contingent liabilities. There can be other monies for which the non-corporate entity is contingently liable. All those contingent liabilities are to be disclosed separately as a separate note apart from other notes relating to the financial statements. This is all from the balance sheet size. Now coming to the profit and loss. This is the format prescribed by the Institute for Non-Corporate Entities. Again, it starts from revenue for operation, other income, then total income and total expenditure. This format is same as as the format we used for corporate entities. Here, employee benefits are to be shown separately. Depreciation, finance cost, and all other expenses are to be clubbed into other expenses. Then profit before exceptional item, extraordinary item, tax expense. This format has been included in the guidance note. In case the entity is a non-profit organization, the provisions of this part shall be applicable to the income and expenditure account in the like manner as it applies to the statement of profit and loss. Then coming to revenue from operations, it shall be disclosed separately in the notes. Revenue by way of sale of products less excise duty if it is applicable. Nowadays,
एक्सक्यूज मी सर, सॉरी
हाँ जी सर,
सर, इसको आप स्क्रीन को थोड़ी पीपीटी को इनलार्ज कर लेंगे, मतलब थोड़ा विजिबल हो जाएगा अच्छे से। हाँ जी सर, हाँ जी, हाँ जी, बिल्कुल सर, परफेक्ट परफेक्ट, अब सही दिख रहा है सर, थैंक यू।
रेवेन्यू फ्रॉम ऑपरेशन में जो डायरेक्ट एक्साइज ड्यूटी होती थी, दैट इज टू बी शोन फर्स्ट ऑफ ऑल ग्रॉस, देन excise duty, then net. But nowadays, there are very less units covered under excise duty. This GST is not to be included in the turnover because it is an indirect tax. Sale of products is to be shown net of goods and services tax, not excluding goods and services tax. Then sale of services, other operating revenues like sale of scrap, export benefits, these are to be included under other operating revenues. In case there is a finance non-corporate entity, then revenue operation shall include revenue from interest and other financial services. Finance cost. We have a separate line item for finance cost within the profit statement of profit and loss. Finance cost shall be classified as interest expense other than interest on partners members capital, interest on partners oblique members capital, other borrowing costs, applicable net gain loss on foreign currency transactions and translations. These are to be separately disclosed. If there are 4 line items, applicable net gain on foreign currency transaction and translation is there, then this is to be disclosed separately apart from other interest like interest on secured loans, interest on family loans, interest on loans to related parties, these are to be disclosed separately. Then if at all there is other income shall be classified as interest income, dividend income, net gain or loss on sale of investments, and other non-operating income. This non-operating income is to be shown net of expenses directly attributable to such kind of non-operating income. A separate note of all these following items shall be given by way of note. That employee benefits expense should be shown separately, like salary and wages, contribution to provident fund and other funds, staff welfare expenses. These all items taken together shall form part of one note, employee benefits expense. Then any item of income or expenditure which exceed 1% of the revenue from operations or rupees 1 lakh, whichever is higher. This is not whichever is less, means if item exceeding 1% of the revenue from operations or rupees 1 lakh, whichever is higher, is to be disclosed separately. Means if your turnover is 5 crore rupees, 5 lakh rupees of expenditure, any item having expenditure of 5 lakh rupees or more, that item is to be disclosed separately. If we have adjusted the carrying up amount of investment, like in non-current investment, we have a permanent diminution in value of that investment. That means there is an adjustment to the carrying amount of investment. That adjustment is to be shown separately. Net gain or loss on foreign currency transaction and translation, other than as considered as finance cost, these are also to be shown as a separate line item. All details of all items of exceptional and extraordinary nature, these are to be shown separately. Then all prior period items are to be shown separately. This is a broad category that these kind of expenditure are to be shown separately. Employee benefits, any item of income or expenditure exceeding 1% of revenue or 1 lakh, whichever is higher. Adjustment to carrying amount of investment, net gain on foreign currency transactions, details of all kind of exceptional items, extraordinary items, and prior period items. These are to be shown separately and cannot be clubbed under any other heads. Then these are the general instructions for preparation of statement of profit and loss. Expenditure on each of the following items should be shown as separately. Consumption of store and spare, power and fuel, rent, repairs, insurance, rates and taxes, and miscellaneous expenses. Basically, this format for non-corporate entities has been derived from what we do in corporate entities. This format is by and large similar, other than there we show equity share capital, and here we show the owners funds. And then in non-corporate entities, we do not show the aging of the debt, trade receivable and trade payables. This is all for financial statements of non-corporate entities, which will definitely touch upon what is the guidance on accounting standard, because in accounting standard classification, there has been some changes in the classification of entities for non-corporate entities. If there are, Hitesh, if there are any queries relating to this, we can take up this first and then we'll move to accounting standard relevant for non-corporate entities.
चैट बॉक्स तो काफी बराबर आ रहा है, अभी देखो इंक्वायरीज।
It will be better that you take up the query and I'll answer as far as possible.
मे बी रजत चौहान कुछ स्पीक कर रहे हैं, बट आपकी वॉइस सही नहीं आ रही रजत चौहान। सर अभी ये क्वेश्चन आया, इज अ हाउसिंग सोसाइटी लायबल टू फॉलो दिस गाइडेंस नोट्स?
Which one?
हाउसिंग सोसाइटी इज लायबल टू फॉलो दिस गाइडेंस नोट, ये राजेश
Definitely,
नारायण का क्वेश्चन है।
because housing society, resident welfare association, they are also non-corporate entities.
एक्सक्यूज मी सर, गुड इवनिंग।
Yes, good evening, जी sir.
सर मेरी कुछ क्वेरीज हैं।
जी sir.
जैसे सर ये फाइनेंस कॉस्ट में आता है, ये फाइनेंस कॉस्ट में इंटरेस्ट आ गया, इंटरेस्ट टू बैंक आ गया, तो
हाँ जी.
उसमें सर जो इंटरेस्ट टू पार्टीज है या डिपॉजिटर है उसका सर सेपरेट नहीं लिखा हुआ, तो सेपरेटली
नहीं नहीं,
ऐड
वो
कर।
आप you can, because that line item is interest expense only. If you can disclose it separately, it is advisable to disclose separately. Other than interest expense is more than enough.
ओके।
Because interest to any supplier is also an interest expense.
ओके सर, यानी कि
Good evening, sir.
Yes, sir.
Sir, I want to know there are family loans standing in the balance sheet, which are
Okay.
long overdue. Should we show them as non-current or current? Matlab, they usually pay 5 to 6 lakh, then they again spread them for 5 to 6 lakh. Usually this in
Sir,
the
please